Welcome back to the next segment of our agenda for this morning. And the old adage that two heads are better than one rings true today as we have the two gentlemen, Beattie and Michael Mortimore, joining us from NS Partners. We'll be chatting about our Global Emerging Markets Fund. Chaps, thanks for joining us today.
Good morning, David.
I think a really nice place to start is maybe a little bit backward looking. So what has the fund really done in the last quarter and some of more recent memory? Because I know if we had this conversation a couple of years ago, we'd be in a very, very different mindset for us.
Well, it's been a really solid period for emerging markets, especially over the last 18 months. The asset class has nearly doubled. Over that period, the fund's done pretty well. So if you look at the last quarter, obviously very strong for us, up 28.8% against 24.1% for the benchmark. Over the year, the fund is up 51.3% against 43.5% for the benchmark. So it's been really solid. And just to remind some of the Ned folks, some of our clients, back in 2024, beginning of 2024, even towards the end of 2023, we had our little macro scorecard, which rates the prospects for emerging markets versus developed markets. We were starting to get more and more positive around that time. The big sort of component of that view was where we thought the dollar was going, which we thought had peaked at around October 2022. I think that was a nice catalyst, a nice tailwind for us through the beginning of 2025. It's a slightly different story this year. It's been, and Ian can dig into that, very much led by technology stocks, especially the semiconductors. But overall, that 18-month period for emerging markets has been very solid. And it's two slightly different stories, I think, over that period. Last year was a pretty broad-based rally. There was definitely some weaker dollar beneficiaries last year contributing alongside technology stocks, whereas this year it's been very, very narrow. But I won't spoil it for Ian. I can just leave it there. But a very strong period for the asset class, and it's been very pleasing to see the fund do quite well over the last 12 months as well.
Thanks, Michael. Yes, your next slide does speak to a little bit more of those finer details. Whenever I see the good, the bad, I think about the West and the good, the bad, and the ugly. But yeah, so where have you delivered a lot of that performance? I see here you speak a little bit to some of the underweights and the overweights and what's really driving those numbers.
Yeah, that's right, David. So obviously a really good quarter. As Mike was saying, we're kind of flagging that emerging markets were looking well set. Didn't always turn out exactly as we expected. But very, very strong quarter, and for us especially, probably even more so. So what worked was our stocks and our overweight in South Korea, the stocks we held and our underweight in China and South Africa. So that was good stock picking and good positioning. We were overweight Taiwan, which was obviously very positive with the AI boom really helping Korean semiconductors and Taiwanese stocks, which are mostly semiconductors. And then we were underweight Indonesia, India, Thailand, Saudi. All those were very, very helpful, and the stocks were pretty good in Greece as well. I won't go through the whole hog, but basically this quarter has been about AI. You either got AI right or you got it wrong. You either had the stocks or you didn't. And we had exposures in IT. We were overweight those areas, and we had some industrial exposure as well to that theme. Not everything worked in our favor. Obviously, the whole portfolio is like to be balanced. So exposure to Argentina and Hong Kong was a negative. Our very small overweight in Brazil didn't really work, nor did it in Malaysia, although those stocks look really good to us and we're very confident on them. There's a bit of underperformance in India as well, and both stocks and overweights in Poland. But all of these were really kind of, really small relative to those big gains, as I said, in AI stocks, in semiconductors in particular. To go down, if you want a bit more granularity, SK Square is a holding company that owns SK Hynix. It's the big driver on this has been the SK Hynix share price, the semiconductor in South Korea, which is moving on high bandwidth memory and memory in general, and those prices moving because of AI. And this is one of the biggest companies in the world in this space. But also, as we're playing it through SK Square as well, we've got some value up reforms. This is a company that's trying to improve governance. And so you're getting a little bit of an extra play as well as the AI direct. And therefore, it's been a very big performer. TSMC has obviously been very good. It's a quasi-monopoly in those logic chips. This is the dominant player in the world and is very, very well set. We might talk about this a bit later on as well. And then we've got the JSET Group, which is a Chinese semiconductor assembly and test company. China's playing catch up. It is actually very, very close behind the US, but it's got to throw more resources at this. So guess what? An assembly and testing company is exactly where you want to be. The ones that didn't do so well were basically non-AI themes. We're very, very confident on contemporary Amperex technology. It's the largest, most successful battery company in the world. It's going to be a play on batteries in your cars, but also in the grid as we move to more renewables. I think this is a dominant company in China. It's going to be a dominant company in the world. It's not done well as people have chased other things, but we really want to hold on to this. Yageo and Sany Heavy Equipment. Those have not worked over this period. Commodity prices may be rolling over a little bit for Sany Heavy. I think we're less confident on those names, so we've taken a bit of money off the table on those two, but not on cattle. Over the quarter, we added to Argentina, Brazil, China, Hungary, India. So you can see what we're doing here. We're actually adding to some of these underperforming areas to make sure the portfolio is balanced. We took profits and added in the places like South Korea, and we reduced the UAE, Greece, Hong Kong, Peru, and Poland to a certain extent. We are now underweight gold. We were underweight oil at the end of the quarter as well, but that's a little bit more of a trading position. As you can imagine, we bought energy and oil earlier in the year as we saw tensions in the Middle East increase. So there's some tactical positioning going on there.
Thanks, Ian. Yeah, you mentioned India and oil, and I know you're going to unpack both of those themes in the coming slides. I don't want to spend too much time on this, but a lot of our viewers would have caught the headlines from the likes of FTSE Russell and MSCI around Greece's movement from reclassification from a developing to a developed economy. Does that have any material effect on the portfolio and the stocks you hold?
Yeah, that's right. Countries that when they get promoted from one universe to another, as it were, they often have a bit of a run. So this might be quite a good journey, but fortunately, as many things in financial markets, often it's better to travel than arrive, as that old dictum says. And I would not be surprised if it's similar here. They'll go and, they'll end up a small fish in a big pond. I think it's good for Greece, and it's probably good in the long term. Whether we ride that and take profit later on as that deadline approaches, I wouldn't be surprised. But we'll see how things play out.
Thanks, Ian. Well, testament to turnaround story there and the institutional strength and confidence they've developed over the last decade or so. So, yeah, moving on to that point of India, the next slide in the presentation speaks to the active and passive weighting. What exactly are we seeing here, and what's the takeaway?
We've written this month about some of the movements in the benchmark in terms of the weightings for each country. And you can see the dominance on one hand of South Korea and Taiwan, having moved from about, say, 30% of the benchmark now to nearly half the benchmark. And there are a few losers on the other side of that, and India's been one of the big losers. So I think its weighting peaked at around 18%. It's now roughly halved, which is pretty incredible. This is a market which in 2024 had been one of the top stock markets in the world for a few decades, along with the US and Denmark, which is basically Novo Nordisk. And so it's been a really tough time. India's, I think, been designated in financial press as an AI loser because of its there's disruption to the IT services industry, which employs around 5 million people in India. So it's really been on the wrong side of the dominance of the tech trade. I just, talking on tech, I just put a note down here that over the last quarter, only 20% of stocks outperform the benchmark. So that just gives you an idea of how narrow market performance has been. And India's certainly been on the wrong side of that. So we wanted to highlight that over these next few slides. So you can see the weightings for India decline pretty dramatically now. And then on the following slide, on slide 5, just highlighting that last year was the worst year for Indian equities relative to the rest of the region since the mid-1990s, which is pretty incredible. In terms of, if you look at it in terms of valuations, it still trades at a pretty hefty premium to the asset class. If you're looking at it over the long term, it's about 1.5 times premium on price to earnings basis. But Ian and I, we could dig into this, why it trades at that premium. We think that there are some good reasons, and I think at these levels it's starting to look a little bit more interesting now. Earnings look to have troughed last year, earnings growth, so that's around 5.8%, dropping from around 33% in 2024. So earnings are really decelerated. But Ian, I think you were mentioning before about earnings estimates might be starting to bottom out a little bit here.
Yes, that's right, Mike. So we had a lot of positives for India when we were very overweight for many years. And then we saw those positives basically turn to modest negatives or drop away. And as you said, Mike, that was valuations, that was ownership, that was earnings. And so we downgraded India and went underweight. Now we're seeing those negatives themselves diminish, and some of them look to start to go positive. So those valuations, ownership, as you showed as well, Mike, looking a lot better. Earnings, are the downgrades over? Are we starting to get upgrades? We're just going through that sort of this last earnings season, and I think that's a tentative maybe. Money supply looks pretty good for India, although it's a bit volatile. FX was a negative, but there's been some government changes to attract capital inflow, especially on the bond market and for banks, and that's probably having a bit of an effect. So the only thing we're really worrying about now is oil. You can see on that chart that you put in, Mike, got the inflows to domestic mutual funds. That's structural. That has not come back much with the bear market. That's holding in there at a few hundred billion rupees a month. That looks really solid. So India's become a market now owned by domestic institutions, which is for us always a good sign. So for us, yeah, we're definitely less negative on India now. We're starting to add. It is a kind of anti-AI trade. It is the opposite to the AI trade. It is sensitive to the oil price, however. So we've got half an eye on the Middle East. But if things resolve themselves, and that's obviously a very big if at the moment, I think we're still going to get some noise and some volatility there. It's still fraught with danger. But India is your play on that calming down. And when people move on from the AI story, India looks very well set. So we've gone from a big underweight. We're starting to add week by week a little bit on there.
Thanks, Ian. Yeah, just again for the viewers' context, the Nifty 50 is the 50 largest cap stocks, highly liquid stocks there in India, and the domestic confidence, I guess, like you mentioned, the domestic flows going into those stocks there is really a vote of confidence. Moving on, you mentioned AI and semiconductors earlier in the presentation, and it's almost unavoidable. I think you mentioned how these stocks become so much more meaningful in the index. You have a slide here with TSMC and SK Hynix in terms of their gross margin. So I guess that's revenue that's left over after subtracting the costs of production of these semiconductors. How sustainable is this, as your title suggests?
I mean, this is the key question for anybody, I think, investing at the moment. These are great plays on AI because you don't have to work out whether, how sustainable the business models are for OpenAI or Anthropic, or how much you're going to have to pay for them in the US. Yes, that's, obviously that's very important for many investors, but you know what, you can go to the picks and shovels. The sort of roadmap we're thinking about is this is a super cycle. So when we've had super cycles in the past, some of them have turned into bubbles, some of them haven't. That framework can sometimes be unhelpful. We're not getting that strong money supply signals to suggest that it's a classic short-term bubble, but it could be a real one that actually in the real economy. It's a technological change. It's a boom for sure. And so I'm thinking of it as a super cycle. So when you play super cycles, whether they're in China or whether they're in Japan or whether they're anywhere else, it's often best to play them through the suppliers to that super cycle. So the resources during the China boom had a super cycle. So the equivalent to Australia and South African resources in this boom, in the AI boom, is semiconductors. And so then you go to look at Samsung Electronics, you look at SK Hynix, you look at Micron, you look at TSMC. Now the difference is TSMC is a monopoly. So its margins are always pretty high. They don't gouge their customers. So they go from moderately high to high. They don't really ever go to super high, which gives them protection on the downside. Nobody makes enough money to get into TSMC's patch, or nobody has so far. So on the green line on this chart, you can see TSMC gross margins are always high, and yes, they're at they're above the old highs, but it's not like they've gone to a crazy level. And also the downside looks limited if we're wrong and the AI boom comes to an end sooner. However, SK Hynix and Samsung and Micron, they are hugely volatile. Not only do they go to very high levels, and we are now at very high levels or expected to be soon, they can go negative. This is not a monopoly. Yes, there's only a handful of players, but it's ruthlessly competitive, very capital intensive. They're both very capital intensive. So, you can see why one always commands a reasonable valuation and grinds higher all the time, and the other one is much more volatile. So at the moment we own both, and we think things are looking very good for them, but you can tell, I think, from this chart which one we think is going to give us a steadier long-term outlook and which one is more, it's more of a boom-bust scenario probably. But at the moment, I think things still look very good. But what I'm trying to show here is our forecast is all about how long we stay at these levels for. That's the key thing to this forecast, how sustainable it is. And we're a lot more confident on TSMC's than we are on Hynix's, Micron's and Samsung's. But for the moment, they all look pretty good, but we have to watch developments very carefully.
Thanks, Ian. I think it's a very important point, and I know you guys write quite wonderfully and in depth about this in the quarterly commentary, so I encourage the viewers to go and have a read and learn more about your views in that space. We can spend forever talking about that, and we're now going to shift a little bit from technology to an older form of technology, that being oil. And I love the title of your slide here saying oil, the dog that didn't bark. Now I have two dogs, one that barks his head off at any sound from outside, and one that sits pensively observing with a wiser disposition. But why, in your view, is oil not barking?
Well, it is interesting that, if you would have told us that the Strait of Hormuz was going to be shut down, there were a lot of headlines coming out talking about $200 a barrel oil and so on. But it is remarkable how those pricing signals can incentivize new supply to come online and supply chains to reroute around that region. That said, it's still a big risk that we've got to watch. And as Ian mentioned, we did take steps to address the risks there. We had a zero weight to oil at the beginning of the year and lifted that exposure as we started to see those macro risks build into March, which have cooled slightly. But you can see that oil is pushing back now above $80 a barrel, but certainly not spiking to the levels that a lot of the more bearish headlines were pushing. So yeah, we're suggesting that it's the dog that didn't bark, and that those, nevertheless, higher oil prices will, push through some short-term inflationary pressures globally. But at the same time, we're not expecting this to be sustained. So, we're speaking to our chief economist, Simon Ward, who is not sounding the alarm on inflation at this point, and the expectation is for the higher prices to roll through the system. If oil prices stay elevated, the risk actually may be, in fact, a demand shock rather than a sustained inflationary pressures. I don't know if you want to add to that, but I think as far as our outlook for money growth and things like that, the oil price is very important.
Yeah. So, from the portfolio perspective, we know this is a risk, especially to what the winners in the first couple of quarters or the last 12 months even. So we added energy names as we saw tensions in the Middle East start to rise. That obviously looked smart, although we didn't go overweight significantly. We just made sure we had some upstream oil names to hedge the portfolio almost. We took some money off the table because we had the view that Mike's just been describing, that we thought, supply will come out, demand will fall at these prices. And sure enough, we saw the oil price come rattling back, much to all the experts' disappointment, I think. Now, of course, we are in a situation where it's not resolved, that there are still tensions. I think it's always difficult on these calls to talk about short-term factors because it'll be obsolete very quickly. But we do note that the US and Iran are still in talks. So although there is violence and effectively war and strikes, military strikes going on, and they are still talking. The back channels through Pakistan are still active. So we don't want to get too bearish here on markets and bullish on oil, but it is something we're watching very carefully. Obviously, the world relaxed a little bit, and then suddenly there are still problems. But as Mike said, guess what? Supply is coming out from all sorts of places. The supply has fallen in many areas that people didn't expect supply to fall. There are issues with diesel and some refined products and other products that come through that strait that we've got to be careful of in individual sectors. But at the moment, I think more volatility, but probably headed lower.
Yeah, it makes me think of, you mentioned cattle earlier, the world's largest battery maker. China added last year 500 gigawatts to its grid. A lot of that is coming from investments in renewables, investments in nuclear power, and you can expect with the volatility that we've had in the Middle East that trend is going to accelerate.
Yes, a lot of the experts said the reason why they were wrong and oil didn't hit 250 or whatever is because of China. And China's demand dropped significantly for oil, but they had already built up their reserves as well, that the government had. But I think, guess what? This is how markets work, and they work quicker than they used to. So, I suspect long term, this will be putting in a top for oil. OPEC looks like it's struggling with the UAE leaving, and I think there'll be more supply and lower prices in the long run. There's plenty of scope for spiking higher though, with the military tensions.
Thanks, chaps. Yes, you're saying markets move quicker than ever, and I think the Chinese government moves quicker than most. So you talk about what they're building in terms of gigawatts in energy storage through clean energy. One of the repercussions of the conflict in the Middle East and Ukraine as well, for that matter, has been the energy security that governments are now approaching their own grids with. And how do you buffer yourself against such volatile movements in global commodities such as coal and oil? So pushing the green agenda, if you will, inadvertently, a lot of conflict we are seeing. And second to oil, the second most traded commodity in history, I believe, is coffee. So before I let you go for your morning coffee, I know, Michael, the greatest contribution Australia have given the world is the flat white. So before we send you off for that, the final slide is around portfolio strategy. What do you really want to drive home today? What are you looking at in terms of indicators out there, and what should the audience recognize as we move into the second half of the year?
Yeah, well, we're actually looking at some of our global macro indicators, and we wouldn't be surprised to see the global PMIs start to decline a little in the second half. So we're a bit cautious on the sort of old-fashioned economy. It's been through a lot of pressures. There's still Trump, his policy volatility. There's definitely some sluggishness around, and if you stripped out AI, it actually looks very weak everywhere. So we see our money supply numbers giving us a bit of a warning about this earlier this year, and we expect that to feed through to some weaker than expected global PMIs in the second half. Now, at the moment, we've got less favorable excess money, which is why we're seeing volatility in markets now. We're seeing some of the hot sectors come back dramatically because there's a little bit less fuel for the asset prices out. Now, that could correct itself depending on central bank actions and a weaker global economy. But it's something we've got to watch very carefully. If that stays negative, then we will have to get more defensively positioned. If, however, either corrects itself because the economy is weak and Walsh determines to keep money supply reasonably okay in the US because we don't get an inflation shock, then that could actually cushion markets and be quite positive. So I know I've given you two different scenarios there that are very different. One's relatively bullish and one's relatively more cautious. But we have to see the data and see how that pans out. Chinese economy has been driven very, very much by exports. So How will that cope with a global slowdown? That we'll have to see. They'll probably try and do some more stimulus, but all the things we've seen so far from China's stimulus has been rather disappointing and rather weak. So I wouldn't be too excited about that, but they do need to do something, I think. Money growth is slowing in India now from a reasonable level, but like I said, I think we've got some good balance of payments numbers coming out after the change by the government. We'll see some capital inflows, so that might be okay. Looking a bit better in Brazil, but as ever, we're looking at politics there very carefully. Earnings revisions were very, very hot in Taiwan and in Korea. They will cool. How much they cool will be very important. And backward looking, India still looked weak, but as Mike was saying, maybe we're at the end of those. So that's a key swing factor. So again, I'm giving you a few what we're looking at here to decide on direction going forward. One of the real big longer term, medium term themes we've got is currencies look really cheap in Asia, especially Northeast Asia. And they look a little bit pricey in Mexico, Brazil, and Eastern Europe. How that will result, rather than just big trade surpluses for the Northeast Asian giants, remains to be seen, how that is recycled. But that's something we want to be on the right side of, I think, longer term. So, if we see some of these things roll over, we're going to make sure we're going to have enough defensive sectors. We're going to have some quality names, if indeed that happens. And it'll be interesting to see if we get some liquidity back, where that rotates to. So all in all, I would say this is looking like we need a more balanced portfolio going forward, that we'll see some broader, this rally, if it continues, will broaden out. And if it doesn't, then guess what? You need a broader portfolio anyway.
Thanks very much, Ian and Mark. That brings us to the end of today's session. In my preamble before the webinar, I spoke about Phileas Fogg going around the world in 80 days. And a big part of that journey was through Eastern Europe, India, the subcontinent, Southeast and Far East Asia, and into South America. So I think you really picked up that baton and taken us through that portion of the market and give us a wonderful lens at the intersection of geopolitics, commodities, the surfacing of quality as expected in the second half of this year. So thanks for your time this morning. I'll let you go for your coffees, and we'll catch up in 3 months' time.
Thanks very much, Dan. Good to see you.